you very much, people. And this works. That's great. So quick show of hands. How many people in here have already bought a stock or an index fund? That's a lot of people. How many have bought cryptocurrency? Just curious. Actually, I have as well. All right. This talk is actually mainly meant for you guys that didn't put up your hand. So you can get an intro to the stock market. It's it'll go pretty fast for you guys. So stay sharp, wake up. I know it's early in the morning, and then go home and Google stuff that you want to dig further into. I gave this talk to a friend, and I realized it's actually quite serious stuff because when I was rehearsing, I had to stop halfway through. Why did I have to stop halfway through? Because he got depressed. Why did he get depressed? Was because the talk was boring? No, although she did find my joke delivery a bit flat. She got depressed because she knew everything I had told her, and she'd known it for 5 or 10 years, yet she hadn't gotten into stocks, and she would have been a lot richer if she had invested. Oh God, responsibility. So I added a few slides in the end of this talk to address this and make sure you guys don't get depressed. But let's start in a happy place. Let's start here in Bansko, and just something a bit random. Did you guys notice the 2 really cool cars parked outside when you walked in? It's a bit random. Anyone saw them? Yeah, you guys saw them? Yeah. I took a picture for the rest of you, and it's here. What's really cool about these cars is that they had, because I had a time, so I had a chat with the owners, and they were 2 retired nomads. And what was funny was that each car had cost $1,000. What? $1,000? But there's a big difference. So who decided who got the luxury helicopter and who got the old Bulgarian car? Both cost $1,000. So the thing is that these retired nomads, they didn't right away. They saved $1,000. They invested and bought the car of their dreams for their retirement. How did they invest? We'll see in a moment. How can you invest? This is how the world's wealth is allocated. And today we'll talk about stocks, which is the blue 16% in the bottom here. I think all asset classes are interesting and have merit, but we have limited time. Next slide is going to be very important, but first let's define what is it a stock is. And there was a lot of hands up, so I think you know stocks is ownership of a company. When we have defined a stock, we can also define an index. An index is a weighted average of the price of a bunch of stocks. For example, the 500 biggest companies in the US. When we then we can have a look at what is a fund. A fund is a company that takes your money and invests it into stocks or bonds or something else. Indexes are really interesting in relation to a fund. If you want to see how a fund is doing, is it making money for you? Because one thing is if it's making money, but you want it to make more money than the average. The stock market is usually going up, so anyone can make money. You want it to make more money than the average, and that's where you can compare fund's performance to an index. What's an index fund? That's a fund that automatically invests your money in a given index. So this makes an index fund very cheap to run. It can run on an old computer that stands in a corner because there isn't much intelligence. It just buys stocks in a given index. Right. This is the most important slide of the presentation and probably the most important slide on the whole Bansko Nomad Fest, because it says more or less everything there is to know about the stock market. It explains the basis of the FIRE movement that is counting on this explosive growth to continue. It says why seemingly stupid people get rich and why the rich get richer. It says that the stock market has grown on average by 10% per year for the last 100 years in this case. So 10% per year for 100 years. How much is that? That's 10 times 100. So it's grown by 1,000%, right? Yeah, that's wrong, because we have the compounding effect that the interests also generate interests. So it hasn't grown by 1,000%, it's grown by 200,000%. And that's what gets you from $1,000 to a luxury helicopter that you see here. There doesn't seem to be a big distance between the luxury helicopter and the old Bulgarian car, but pay attention to the scale here. It's a logarithmic scale. We are interested in growth, not absolute values. So it's a logarithmic scale. If this was on a normal scale, go through the roof of this building. This graph also tells us why most financial advisors stay in the stocks for the long run, because although it's going up like crazy, we also have some steep downturns. And since it's on logarithmic paper, these bumps are actually pretty steep valleys. We had during COVID, the whole thing fell 30% in just a month. And that's a roller coaster down to hell. If you are invested in the stock market, it's no fun at all. Okay, is this growth going to continue? That's the most interesting question. And it's difficult to say for sure, but I would argue yes. And I would take this, you start my argument in this very room by pointing out that every one of you guys in here, you have a better life and a higher standard of living than the king did 100 years ago. You have a faster car, you get hot showers, electric lights, way better healthcare. Why is that? Why is it you guys have a better life? That's because humanity has progressed. Who is in the business of progressing humanity? That's companies. Companies invent stuff, cars, AIs, they produce stuff, gasoline, electricity, the oatmeal you ate this morning. If you think that in 100 years' time that the people sitting in this room will have a better life than you guys, but also even a better life than the billionaires of today, if you think this growth will continue, then stocks could be the right place to be invested. All right. Let's take a step back and I'll tell you a little story from real life, from my life, about how I got into stocks. I was nomading around the world. This was 15 years ago. And I tended to open bank accounts wherever I got around. And I found the same pattern emerging, no matter if I went into a bank in Asia, in the US, or in Europe. They'd notice I had a little bit of money sitting there. I don't think it has to be much. Maybe if you have 20, 30K, they'll try and get a slice of it. And they suggest I had a chat with a financial advisor to see if she could help me out. And why not? I wasn't busy, so I had a chat. And she could actually help me out. She was best friends with Gordon Gekko himself. She knew him from college. She had him on speed dial, and he was really good at finding hidden gems in the market, seeking out niche stocks, and invest my money. And this sounded really great because at the time I hadn't really invested in stocks, and it seemed a bit mystical, the whole thing. So great, he could help me out, right? It turns out it wasn't so great because when I looked into it, it turned out that my financial advisor was actually this girl in disguise. And the investment proposal she's putting in front of me there is a contract for 15 years of slavery. It also turns out that Gordon Gekko himself is no better at picking stocks than this guy. Okay, bold claims, Martin, bold claims. Yeah, let me explain. This monkey illustrates a bunch of studies that have shown that most fund managers have a really hard time outperforming a monkey throwing darts at a stock chart. And even if you do find a fund that outperformed, because you can look at historical performance, but usually it doesn't carry over. Here they investigated the top funds in one decade, the top funds in the next decade, and they found out that only 4 out of 248 funds remained in the top. So it's like finding a needle in the haystack. You would have had to find one of these colored squares I made there. So yeah, so it's and this is a leaked document from BlackRock, a big investment management firm, about how they create their funds. And to be a bit authentic, I actually went through my Gmail and found a proposal that was pushed in front of me once. Let's have a look at it. First of all, it turns out that Gordon Gekko himself is actually, yeah, there's a lot of data, so let me just explain. It's because it's real. It turns out Gordon Gekko himself is actually BlackRock, which is the biggest asset allocation company in the world. So not something I couldn't have found myself. It also turns out that Gordon Gekko's niche hidden gems in the market, he went out and found US Treasury bonds and Apple. US Treasury bond is like the biggest government in the world, the biggest company in the world. not very niche, not something I couldn't have found myself. Also, they are forced to show the performance plotted against the index, which you see there on the left, and you can see he performs very much like the index does. He doesn't do anything different from anyone else. The worst part about this, though, is the costs. First of all, there's something called an initial charge. What's an initial charge? Yeah, that's the absolute worst thing it can be. It means that my new best friend, my financial advisor, advises that the first thing I do, preferably before leaving her room, I give her 5% of all my money. I give that to her just to get into this fund. And if you think that's good advice, then talk to me later, because I'd love to give you some advice. She also advises that I continue to pay 1.5% of all my money for every year until I retire, because we're talking about the long term here. So here's over 30 years. This would cost me 36%. That would mean that I'd have to work 15 years longer to make up for these costs. Crazy stuff. Let's see if we can do better. First, since you're all digital nomads, I guess just for fun, put in what the cost of taxes here. It definitely pays off to think about taxes. You don't have to move country. You can also use pension schemes or an accumulating fund that doesn't pay out until you actually sell it. So you can decide yourself when you take your tax hits. But let's get back to asking whether we can get invested into the stock market cheaper than 36%. Remember, I'd still make money by giving her 36% of my money because of the insane growth of the stock market. It would still be a good deal for me, but it's just a bit expensive. Could I get a bigger slice of that pie so I don't have to slave away for 15 years? And it turns out, yes, I can. We noticed that Gordon Gekko himself, he just kind of followed the index. And I mentioned index funds earlier. Maybe that's something we could use. And indeed it is. How do you get into an index fund? I won't get into too much detail, but it's pretty easy. You can probably buy it in your net bank if you ask them to enable trading, or, which I recommend, you should open a brokerage account. It's very easy. You just Google brokerage account and then whatever jurisdiction you're tax resident of, and you'll find out how to open it. This is a screenshot from a brokerage account where I push in 8,000 euro into an index fund that I found. And we can see the cost of that is 0.1% for the transaction fee compared to 5% through my bank. And the yearly cost is 0.3% compared to 1.5%. That's heaps better. I used to be a bit nervous about pushing this button, and one thing to buy stuff in this interface, and what I was nervous about was, do I get the right price? And as the monkey kind of illustrates, no one really knows the right price, but I'd say one argument for whether or not you get the right price when you buy something is ask yourself, what can I get for it if I want to sell it after I bought it? For example, if you buy a brand new car and you want to sell it the next week after you drove it a bit around, it has dropped significantly in value. We don't want that to happen on the stock market because we're pushing in big amounts. We're pushing in our retirement savings here. We are in luck in this particular case. The difference between the buying price and the selling price, which we call the spread, is very, very low, and it ends up being €2 on 8,000 euro. Good stuff. So I have you convinced you should look into stocks, but you also read the news this morning and it's looking grim, isn't it? Bad news sell newspapers. Bad news affect human emotions and definitely make us not want to invest. Bad news rarely affect the stock market. The stock market doesn't really care. It just keeps going up. It's erratic, it's volatile, it goes up and down like crazy, but mostly it goes up, and it very rarely cares about bad news. Sometimes really bad things do happen, though, also to the stock market. This graph shows the red, the red values here show downturns in the stock market. We see though that even like cataclysmic events like World War II, the stock market dropped by maybe 80%, and it was also very bad for humanity. But even that is still a small bump on the road to the helicopter, which we have up there at the right. It's going up like crazy. There are some horrible events happening, but they're just in the big picture, it's just minor bumps, and it just keeps going up. Even if you had predicted World War II, should you sell? Should you sell your stocks? And I'll say it depends. Of course, if you know it's going to happen tomorrow, then you can see on the graph, yeah, it's going down like crazy, so sell. But what if you predict, oh, World War II is going to happen, but you're a bit wrong about the timing, so it doesn't start until in 5 years? Should you have bought stocks, or should you sell your stocks? You should buy stocks, because for the next 5 years, it's going to go up like crazy, even though you hit World War II. And if you end up selling your stocks, you have to ask yourself, when do I buy again? Because we can all agree we want to be on this graph that goes up to the helicopter. So timing is really difficult. Here someone made a study that said that over a 20-year period, you would have gotten 8% per year on the SP 500. That's pretty insanely good. But if you had tried to game the market, you had to be very precise, because 2 years, it's 7,000 days. But if you had missed out on the 30 best days, you would have gotten nothing. You wouldn't even have gotten the old Bulgarian car, and definitely no helicopter for you. It would have gotten you to 0%. So if you're trying to time the market, you have to be very, very precise. Good. So all this leads us to a simple strategy called the buy and hold strategy. That basically says, buy stocks and just hold them until you need the money. You could start with an index fund. It's pretty easy. It gets you spread over the whole market. The strategy has two advantages. The first advantage is that it's very well proven to, as I just said, I went through some research. It's actually, there's some good data backing it up. So if anyone ever challenges you and says, okay, what are you doing? This is a ridiculous strategy, then you can put a bunch of papers in front of them, a bunch of research, and saying, might be a stupid strategy, but there's a lot of research that says it might actually be one of the best strategies around. It's also a very easy strategy, especially if you can stop checking your brokerage account all the time. Because you just push money in, and then you can go back and do your work and your free time, go hiking in the mountains. So this is a really good starting strategy for you. You might log into your brokerage account and you're buying some index fund, and after a while you see there are all these stocks in here as well. Maybe I should just buy stocks directly. What do you think, Martin? Should I buy stocks? And a bit surprising, because of the monkey theorem that says no one can really outperform the market. But a bit surprisingly, I'm saying, yeah, why not? If you feel so inclined, because no one can really outperform the market, is what the monkey theorem says. But that also means no one can underperform, because if you could consistently underperform, you could just do the opposite of what you'd otherwise have done, and then you'd overperform. So as long as you pick stocks with a pretty tight spread, like I talked about, and then be aware of a few other things, diversify your investment, but Google a bit, and then be a bit aware that most humans, they overestimate their own abilities. For example, 93% of you guys, if I asked you, then 93% of you guys are better than the average driver. And that's statistically impossible, but that's what a study has found. And there are several other studies that find that humans overestimate their own abilities. And especially if you're new in the stock market, you're probably not better than the average investor. So maybe just pick a simple strategy and stick with it. And definitely don't follow your emotions when the market goes up and down. All right, let's get back to my depressed friend who knew all this stuff but didn't get around to investing. And since I'm a economist than a psychologist, I shall address your emotions with a little behavioral game that I made right here. Let's see how that goes. So these are coin toss games. You flip a coin, the first game. If it's heads, you win $110,000. If it's tails, you lose $100,000. Who would play game A? Anyone would play it? One person there. Excellent. One person there. Most people in here should not play game A. Why? Because a few unlucky coin tosses will wipe out your, your net worth completely. It's stupid. It's too much risk to take unless you're like a billionaire. What about game B? When you would play game B, same game, less stakes. Would play it? Maybe light play it. Yeah, why not play it? It's a positive sum game. You're gonna win in the long run. Especially you should play game C, which is the long run of game B, where statistics is in your favor, and you're very unlikely to lose. Who in here would play game D, where you lose more often than you win? Would play it? No one would. No one should. Here's my question to you. If you were offered to play game B or game C, but you declined, you couldn't be bothered. You declined to play game B or game C, even though it's offered to you. Didn't you implicitly choose to play game D? Aren't you playing game D then? I illustrated a few iterations of game B here. We can see the red line is if you chose not to play. It's very nice. Your net worth stays the same. You don't lose money. You don't make money. The blue line is if you're playing. You can see sometimes you're losing. Sometimes it's you're winning. It's very volatile. And I can assure you, if you're playing, if you're on the red line, but you're thinking about, and let's just look on the left side here, you're thinking about switching to the blue line, you think that's a good place to be. But I can assure you, when you're sitting there and you're moving the mouse pointer to the buy button because you want to put in maybe a year of salary or something into some index fund, because I told you that's a good idea, I can tell you your hand is going to get heavier, time will slow down, and your thoughts will start going really quickly about what might go wrong in this case. And the red line will feel very nice and safe and comfortable. And maybe you'll walk away, maybe you'll put in way less than you thought. And I'm definitely guilty of that. So the red line will seem very nice and safe. So on the right side, I illustrated the exact same graphs, but with a different scale. So exact same data, exact same red line and blue line. So my question to you is, do you still think that red line seems nice and safe and comfortable? Something to think about. Go home, think about what I said, and gather more information. And this talk is called What You Should Know About the Stock Market, not what you should do. You do you. Do the best you can with the information available to you, and that's really what anyone can be expected to do. And in that way, you shouldn't be depressed in 10 years' time. That's it.